So today I'm presenting on fringe benefit tax. Some of you come most years. It is one of those taxes that comes once a year, comes in hard, goes quickly, and then we all forget about it. We panic for a moment and then it's gone. It is also a nuisance tax, I call it, in the sense that there's so many little minor things that you have to consider that could end up adding up to a lot if you haven't considered them. So what I mean by that is that, you know, if you're providing larger things like cars, entertainment, those bigger items, if you like, laughter, living away from home, and you haven't really given it too much thought, or you thought, oh look, it's probably okay, I'm just going to not claim it as a deduction, or I don't really want to go there, I'm just going to hide my head in the sand. And some people do that, amazing. They may end up with a review because why? Because they've got cars listed in their tax return, but there's no FBT being lodged. So that's just a giveaway. So with the ATO, they're getting more sophisticated with their data matching, so you have to be a little bit cautious. And we are when we try to complete tax returns. I have advised clients before that I've seen have cars, don't do FBT returns, say they look after it themselves, they don't look after it themselves, they get an ATO review, and then they've got a problem and they come and talk to us. But I always think that if you do think you might have a problem, come and talk to us beforehand, because I always find that there's probably something we can do to reduce it substantially, that it's probably not as big a pain as you think it is. So there's quite a few exemptions, but say for a vehicle, it may be that we just do an employee contribution. The owners have a vehicle, they've got a loan with the business, maybe there's an offset we can do to reduce that taxable value substantially. Maybe they're exempt vehicles, which I'm going to go through the presentation today. If they're exempt, maybe, you know, they're out, so you don't have to pay FBT. And maybe they're not available for private use. The owners or the employees travel quite a bit. Maybe you can store it in some sort of car park, airport, which is exempt, you know, not available for private use. I'll go through that in a bit more detail, and you might be okay. So again, I say, have a think about it. If you've got any concerns, come and talk to us. Now today it's myself and Melanie. Melanie can stand up now, I think she'll have to embarrass her suitably. She's going to present on single touch payroll. Somebody told me here they're not here to hear me, they're just here to hear Melanie. So that's great, Melanie, already you've got someone that's keen. Now the topics that I'm going to discuss today, pretty much what the flyer said. Big overview of FBT, just 2 minutes, just a quick reminder, get you in the mood. Yes, you have to be in the mood for FBT. What's new in 2019? I will discuss that in great detail. Investigating entertainment. I think it's probably good to go through some examples of what is entertainment, meal entertainment, and how do you treat it. And I think that sort of gets you thinking about it. Exempt vehicles. The OTO pointed out that a lot more exempt vehicles are being used. So are you getting it right? That's the question. And what safe harbours exist? Payroll tax, recent activity, that's going to be short and sharp, and single touch payroll for small business entities. And Melanie, I won't steal her thunder. Then at the end we've got some questions. Now if you want to raise your hand and ask a question during it, please do. I won't be phased. I may not know the answer, but who knows. But I can leave questions and answers to the end. Or if you feel not comfortable talking to me, please talk to your advisor after the presentation. They'll get a copy of the slides as well. And they're fully versed on FBT, by the way. Have we got any other tax partners in the room? I know I saw Tony Fittler here, but I can't see Peter. They just all came for the breakfast and then left, didn't they? They're not interested in hearing me present. Okay, clearly. So the overview, I just want to start with just dates, you know, the things that normally, oh, you can't see anything. Oh, there you go. Keep in suspense. No, that hasn't changed. It's still 31 March. Now you might ask yourself, why 31 March, not June? That was really a bit of a ATO brainstorming thing, saying they had a moment in time where we couldn't possibly get all the FBT returns and tax returns done at the same time, so let's make it a different date, just to make it simpler. No, that's not much simpler, but there you go, it's 31 March. If you don't lodge with us, and there's people in the room that may not be, we're not their agents, and you do it yourself, fine, but you've got till 21 May, you don't get our extensions. What we need to remember though is if you do have extensions till 25th of June, the payment is due on the 28th of May. Now, as good as our guys are, sometimes they miss that point, but mostly they're pretty good. So what normally happens is we prepare an FBT calc. Doesn't have to have the FBT return prepared, so we got all the numbers for the 28th of May, so we can make sure we advise you with some time to make the payment. You know, most employees know they've got a liability on the 28th of May. So remember, the extension is only for lodging, not for payment. Once again, FBT rate hasn't changed. We've had a number of years that the FBT rate has been changing. So now it's stable, 47%. You'll all be glad to hear about that. And then we have these type 1 and type 2 rates. And that's all to do with about whether type 1 is you've got a GST inclusive amount. Remember, when we do the calculation, it's GST inclusive that we look at, not ex-GST exclusive. Even though you've already claimed your GST, and this number, the 2.0802, takes that into consideration. Type 2 benefits, if you recall, you know, there's no GST on them. And whenever we're doing our payment summary, which I think Melanie's going to talk about some great exemptions there, but reportable fringe benefit, whenever we're doing that, so a benefit being provided over $2,000, you know, that amount is always times by 1.88, the type 2 benefit, whenever we're reporting it on the, it doesn't matter whether there was GST inclusive or not, it's always by that 1.88 for the payment summary. And these are all the things that we check when we're doing your FBT. Now in the room we do have not-for-profit, so I'm going to go for-profit, not-for-profit, so you know who you are and know what that means. Now if you're a for-profit, you can switch off for a moment, have a coffee, and please help yourself for a coffee or some food anytime if you really need to wake up. It can be a bit of a dry subject at times. So if you're a not-for-profit and you're a public benevolent institution, hospital, those kind of organisations, you know who you are. Basically, we can give you donations and we can get tax deductions as the public. So they get this extra benefit, these caps they're called. Now why is the cap there? The cap is there so not-for-profits are probably disadvantaged at times because, you know, they have limits on their funds and they basically benefit the community. So they're doing government a massive favour by being there. And so they're given these concessions because they may not be able to pay market rates at times, so they get these caps. The caps are effectively, and we call them 30,017, that's grossed up. But what you need to know is that effectively if it's GST inclusive amount, it's 14,421 is the limit you can provide. And all these things you can provide is basically you can pay for kids' school fees, you can do really pretty much anything with it. And they don't show on your payment summary. There was this additional cap of $5,000, which is $2,403 for GST inclusive, where not-for-profits, and I'm saying DGRs, you'll know what that means if you're a DGR, if you're not, don't worry, you can effectively provide a meal card up to that value, $2,403. So you can go to a restaurant, do whatever you like, right? No problem. The only thing is that meal card, anything meal, and that'll be part of your effectively your payment summary. So that'll be reported on your payment summary. But the other stuff won't be reported. What I wanted to just say about this slide, sorry, before I move on, it just came to me, is that what we've noticed is, the question I always ask myself is, how does a not-for-profit know? Oh, yes?
So you said that the 30,000 cap is not reportable, but we had to actually adjust our payment summaries last year because it is now reportable. It does need to be put on the payment summary.
Yeah, it depends what
the term reportable.
Yeah, it depends what the benefit is. So if it's meals, they're definitely reportable. So what I mean by that is,
it was the 15,899 that had to be put on the payment summary.
Was it an excluded benefit? Do you know what the benefits were?
They were just salary sacrifice and FBT allowance.
Okay. If I can talk to you after, if you wouldn't mind.
It is, we do the same too. We have to report it on, but it's not counted in the taxable income.
Yeah, okay. So it's reported on your FBT, but everything?
Yes.
There's not excluded benefits that would not be reported on there?
Super's not, additional super's
Yeah.
not.
Okay. All right. So basically, we've got our not-for-profits in the room. So on the payment summary, certainly the sacrifice meal entertainment would be, and the 15,899 and the 14,442, most of those benefits, what you're saying, would be reportable. So that's on the payment summary, which goes to the ATO. Now, and I'll confirm that with the not-for-profits after. I'll send you an email. Because obviously they've had some inquiries about that, which is great. Good, thank you. What I wanted to say is that the question I always had is here is whether I have gone to some not-for-profits and they actually don't when they're doing the FBT, they don't take the cap into consideration. It's unusual, I think. They might separate it, so the HR does the cap maybe with a software provider, one of those FBT providers, and then the other part of it, if you like, all the entertainment cars and so on that aren't part of the cap, the FBT person does. So the question I always have is, how do you know the cap hasn't been exceeded? Now you would expect that it wouldn't be, but I think you just need to have a look, make sure that it isn't exceeded. If it is exceeded, you have to put an FBT return in for the whole lot, not just for the one that exceeded. But obviously you only pay FBT on that excess. So, look, I've got to say not-for-profits is a tricky area. There are a few different rules there. So that's why it is fiddly and you have to keep looking at the legislation. Overview, just on documentation, there's still penalties for non-lodgement. I always think that the thing to watch out here is for it's not so much a penalty for non-lodgement FBT, but it's more the FBT liability, the interest, the penalties, all those extra things that you wouldn't, you don't take into account at the time when you're saying, I won't bother with that. The other thing is significant global entities. Everybody here in the room will say they're not a significant global entity, so we don't have to worry about this, but I just want to put a warning out there. You could be a subsidiary of a foreign entity. You could be a very small entity in turnover of, under 2 million or something like that. And we've had them, or there's hardly any income at all. But the reality is that they could still be a significant global entity, which means that they're accounted for in the financial accounts of their parents, and the parents and worldwide income is greater than $1 billion Australian. Probably no one here in the room, but you can be caught out. And the penalties are excessively large, so that's why you should always, if you are a foreign-owned entity, give that consideration. We always ask them when we do the return. Was there a question over there, or was it just a wave? Okay, great. So overview, this is just a little summary for you. Who have you provided entertainment for? Is it client or is it employees? First consideration. Well, I think first consideration, have you provided entertainment? And I'll go through that in a bit more detail. The other is meal entertainment. Is it actual method you're using or is it 50-50? This is slides based on actual, and you will get a copy of all the slides after. Now, I was of the view that you should get the slides today in your lap so you can write some notes, but Kim knows better. So, she's the boss. So she said, no, you can have them afterwards. So there you go, saving the trees. So are you providing entertainment, first of all? And I'll go through that in a minute. The next question is it to employees? Is it to clients? The next question is, if it's employees, can you get an exemption? And if you can get exemption, yes, no FBT, no tax deduction, and no GST. So these are little quick summaries there. I'll go through entertainment a bit more in a little while. The other question is the 50-50 split. Have you elected to use 50-50 split? So you've already considered the actual method, which is on the left-hand side. You've considered all that, and you think, well, no, I might just consider it. Do I need? Have a look at the 50-50. The only thing with the 50-50 is that you gather all your client entertainment or your employee entertainment into one bundle, and you don't get all these minor exemptions, property, or the minor and infrequent under $300 exemption, all just goes in together into one pool. Split it in half, and you pay FBT on half and claim GST on half, etc. So sometimes you really need to consider that at the beginning. I've done it for some clients at the end, but it can get quite fiddly. FBT exemptions, just a reminder, the things that are coming out the most with these FBT exemptions are, oh, they're lost now, it's over the page, good, is the minor benefit exemption keeps coming up, and I'll go through that. Work-related deductions, so if you're providing portable devices, you know, work-related, only if it's work-related, mobile phones, all those kind of things. Also, you can, if you're a small business entity under 10 million turnover, then you can provide multiple devices. Again, they all have to be work-related. Protective clothing, I'll go through that in a bit more detail. A briefcase, which we've talked about. Can a Prada bag be a briefcase? We talked about that in FBT presentations in the past. Probably not, but we'll see. Tools of trade, hammers, you imagine. Maybe my cap in there is a tool of trade. Exempt vehicles is another exemption, which I'm going to go through in more detail. And LAFA. LAFA in limited circumstances, but it's still living away from home allowance. Still available. I'll talk about that in a bit more detail. So that sort of just gives you a bit of an overview of, you know, FBT. So now let's get on to what's new. Now, I had a look everywhere. I had a look at ATO rulings, determinations, and really there's only been one guideline in the last 12 months, I'm sorry to say. And that's PCG, they call it. I can't remember what it stands for.
Compliance code.
Yeah.
Practical compliance.
Practical compliance guidelines, thank you, Melanie. I knew she was there for a reason. 2018/3. So that is the only practical for exempt vehicles, which I'm going to discuss when I get to the exempt vehicles. That's the main new thing. So that's, in some ways, that's good because you know what you've been doing is either you've been wrong in the past anyway, or you know you've sought advice and there's nothing major. And I'll go through that. That's probably a safe harbour for exempt vehicles. Now the other one I just wanted to have a look. I looked at the FBT subcommittee minutes. So the states and territories of the ATO get together and discuss. They ask questions to themselves and say, you know, how does the minor benefits apply? How do the exempt vehicle, you know, is there any safe harbour? So they had those discussions. Anyway, there's only 3 meetings, and minor benefits and exempt vehicles popped up again. Also, every year the ATO brings a compliance guide out, and in 2019 they brought out the compliance guide, and they talk about what are the hot spots in FBT. And they've said that tax-exempt vehicles, again, employee contributions, so reducing employee contributions, whether there's GST on it, whether it's accessible, living away from home allowance, there's people claiming it which shouldn't be claiming it, that's narrowed substantially over the last few years. Non-lodgement of FBT returns, always a giveaway, and car parking. Now car parking, remember if you're under 10 million turnover, you might get an exemption there, so you might not even have to go and worry about car parking. The Board of Tax was talking about compliance costs, but I think, is Stephen in the room? No, he disappeared.
Steve's up back.
Oh, is it? Is he in the back? He's just not admitting it. No, he's run away. Stephen's in the back. Yeah, okay, he's run away. Can't blame him. I was going to pick on him. But anyway, FBT compliance costs. Basically, the Board of Tax took on the question about, you know, should we reduce our compliance costs? Because it's a big compliance cost to employers. Anyway, at the moment there's nothing out on that, so sorry to hear. Can't help you there. But they have thought about it, they know it is an issue. Alright, so what's new? Third party. Now again, I don't think this is new, it's more of an ATO concern, something they've brought up. And they consider employers probably overlooking this more than anything else. So the question is, an employer is liable for FBT if the employer or an associate of an employer provides a benefit to an employee or an associate of an employee. So I give my, HLB is here, one of the charities, let's pick on a charity, gives our staff tickets to their golf day. We don't pay for it, no one pays for it, it's just a gift. The question is, who pays FBT? You know, is there a liability? Who pays that liability? And so on. So these are the questions that you'll be asking. Now the thing is with those benefits is that it's quite tricky because, you know, they can be small and they can be big. If the employer is aware of the arrangement, and you know when an employer is aware of the arrangement, and knows that it's done for an employee that is obviously an employee of the HLB, if you like, then it's the employer that has the FBT liability. So if a not-for-profit provides 3 tickets to their golf day, then HLB potentially has an FBT liability. You can't use the minor benefit exemption, I understand, because it's not them incurring the expense. It's the not-for-profit incurring expense. They potentially don't care because they don't pay tax, but potentially they might pay. They won't pay FBT. It's not their employee, and so on. So, who's liable? It is HLB in that case, the employer of the employee. What's the liability amount? It's the value of the benefit being provided, and you can just easily ask the not-for-profit. If they don't want to tell you the value, or they don't know, they can't, you know, put a value on it, which I find it hard for, you know, a golf day. But if they couldn't, maybe there's a way that you can get out of it because you can't determine the value. But basically, there's been a few audits on that, and there's been some adjustments in that area. So I think just to be aware of it more than anything else. You know, if I think about it, there's a lot of employers that get benefits, my husband included. He doesn't work for HLB, so it's okay. I don't know anything about this, and I don't do their FBT. But you can imagine in the building construction industry, there's probably a lot of benefits being provided there to employees of large corporations. Whether they know, and maybe the employer doesn't really know about it, it's not an arrangement with the employer, so maybe not an issue, who knows. The other one was exempt clothing. Now, why is this so exciting? Well, again, it's the FBT State and Territory meeting, the ATO getting together, discussing hiking boots. Could you imagine being in that conversation? Hiking boots, protective clothing, and exempt. Riveting. Anyway, they are, if they're provided to a field staff geologist out on the field. So, effectively, I think what you need to look at is that if you're a construction worker or a landscaper, do you have any of those staff, you know, that you're providing sunscreen, hats, sunglasses, it may be steel cap boots, it may be, you know, thick jeans, it may be, I don't know, you're in a shopping centre and employees have to go into the freezer. They put their big parkas on and they're just there for that purpose, to put on and go into the freezer. They're provided that. They're exempt benefits. So just thinking about those things, I mean, most people just claim it, they don't think about it, right, because it's work related. But there is an exemption for it, so no stress there. And I think what the ATO looks at it, and what's something you can think about it, is there, when you're providing these kind of benefits, protective clothing. So protective clothing is exempt, can be an exempt benefit. And it doesn't come within the FBT regime. So is there a risk of illness? So, you know, a person is outside, is there a risk that the weather, the elements, so a parking inspector, good on him, poor thing needs a brolly and a jacket, rain jacket. If they're provided, again, there's a risk of them getting ill if they get cold and wet. The risk's not too remote, you know, it's obviously clear that, you know, they get wet, they're going to get wet and they're out in the lemons. And the employee uses it for the business. It's no good if they take it home, and I mean, they take it home, yes, but they wash it, yes, good. But if they're just taking it home and using it for every other day, now I can't imagine you wearing steel cap boots or maybe the parka, but who knows, you know. So this is how sometimes FBT can be onerous, and I wonder whether employers are thinking to that degree. That would be my question. Unfortunately, they have to. This one's a bit controversial in my mind, but I mean, interesting. I thought for very few people this would apply. And it's really more about, you know, you provide a vehicle. You provide a vehicle for your staff, they take it home. This isn't a work vehicle, this is not an exempt vehicle, this is a vehicle they use every day, home to work, and the employer provides the vehicle, it's the employer's vehicle, and there's all these other criteria, but effectively, is it statutory method, easier said than done, is it a 20% times the cost of the vehicle times the days available for private use, which is usually just that, 365 days times 20 times the base value of the car. Pretty straightforward, right? Then there's the operating cost method where you look at, you know, the costs of the vehicle provided at the holding time and goes on from there, and it takes a percentage of business. Some of you would know it as logbook method. And you say, what's the private portion? So it's all sort of well known that that if you park the car on the employer's premises and give the employer the keys and you travel for 6 months holiday or something like that and use a statutory method, it's already well known that the car's not available for private use for those 183 days. So you can reduce your FBT liability, which is great. Or, you know, there's a lot of staff that say they're constantly travelling all the time and you're using the statutory method. That's another way to reduce it. It's not available for private use if it's sitting in the employer's garage with the keys and no other employee can access it. And there's a policy to that effect. What was interesting was that what someone was trying to say was whether you could use this methodology of not available for private use under the operating cost method. Under the operating cost method, you know, your logbook method, you don't really have available for private use. What they're potentially saying is that you could reduce the benefit if you employer held the vehicle, so that it doesn't, for those expenses at the time that the employer was holding the vehicle in their car garage locked up with the keys in their hand and so on, in the employer's hand, that potentially could reduce the costs and effectively reduce your liability. I don't know, like, it hasn't been tested. It's something to think about, but it's in very small circumstances you use it. One is you have to have a logbook, you'd be using the logbook method, and the other is that the cars would be parked in the employer's premises for whatever reason, and you had a policy. So really unique circumstances. I'd probably recommend a ruling on that. I wouldn't just go ahead and do it. Something to discuss further. But anyway, the other thing was, there was one more thing with the vehicles, which I thought was, oh yeah. The ATO was saying that some people taking their cars, saying to their employees, take the car home for security reasons. So, you know, it's in your garage and secure, and not paying FBT on it. Well, it doesn't work. There's nothing in the legislation saying that if you ask the employee to take it home for security purposes, that there'll be no FBT. Nope.
Can I just ask, does the FBT exempt component, leaving it at work, still apply on novated leases?
Yeah, I think it's which method you're using on the vehicle, on the novated lease. Yeah, you're using statutory, yeah. So it's available for private use. The other question was, you know, if I park my car, if I park the car in a certain spots at the airport, and some of you know this, we've discussed it before, but there's more arrangements available in different states now. So you can see there's these class rulings. So Sydney Airport Corp Limited, they have a specific area where, you know, the employer has to make the arrangement with the airport and say, you know, as staff travel quite a bit, or this staff member travels quite a bit, we're going to park the car there. They take note of when it's available in their possession. They take the key. No one can actually access that vehicle until the employee comes back. So it's probably not a bad trick if you have a lot of staff that travel quite a bit and you have that arrangement with Sydney Airport. Does anyone have that arrangement at the moment? Something to consider if you're paying high FBT and your business portion is quite low. What attracts the ATO? Good question. What attracts them? I always think.
Can I just ask a question? So if I have a general manager for aged care home that is on call 24/7, and I make a vehicle available to them, and they have to take it home because they're on call 24/7, is that then considered to be FBTable, the fact that they have to take it home?
I would say instinctively yes,
yeah.
Because they meet all the criteria.
Yeah.
The question I would have is, does they keep a logbook or do they use a statutory logbook? Yeah. So the question would be then, what is business use and what is private use? And, you know, in case that, you know, home to work would be private,
yeah.
But when they're called out, likely business. There's always nuances with FBT, and sometimes there's you know, the FBT state and territories have met and discussed something which isn't in the law, and sometimes they don't bring out a ruling about it, but it resolves some of these questions. But no, generally, won't make a difference. So the ATO, I mentioned, releases a compliance program for 2019. These are the hotspot areas. So yeah, I know, internet cost reimbursement, really? But I think what they're saying there is that your employer's paying all the employees' internet. Like here we have a policy. So if it's so much, this much we will reimburse as business, that's our policy at HLB. I think every employer should have a policy as to the amount. It may be certain execs or certain people use it more than others, so they might have a different percentage. But obviously some employers are actually reimbursing the whole internet costs and claiming the whole amount, and not paying FBT on any of it. Nalika?
What if the amount that you're reimbursing is higher than the employee is actually spending?
Oh, that's an issue, isn't it? Yeah.
Everybody has a special
What are they
plan.
paying? Sorry, what are they? Oh, they've got.
A special plan, which is less than what the company is reimbursing them.
Yeah, so they have a plan, and the employee is paying that amount. So they might have $100 or something like that as a plan a month, and the employer is reimbursing.
350.
Oh yeah, it's really odd. I've never seen that. Has anyone ever seen that? Yeah, still got a problem. I think you'd have a bigger problem. I think the question is what the other $50 is, an allowance or something, you know. Yeah. Have you seen that? Oh wow, interesting. Yeah, I think you come and talk to me now.
So with internet costs borne by the association, is it still acceptable to get a declaration at the end of the year? The employee declares 80% work, and therefore the FBT is the 20% portion. Is that still acceptable?
Can I just clarify? It all depends on the fact, right? Can I just clarify? If it's the employer is paying the internet business expense,
Yes.
so the premises, I would say that's not.
No, sorry. We allow certain staff to have computers at home and we pay the connection fee.
Right, so their home internet,
That's right.
effectively, yeah.
And we get an annual declaration of usage percentage.
Yeah, I mean, if it's discussed beforehand and there's particular reasons for it, I mean, it comes down to the employer having to document and prove that person, that's part of their package. You know, that you're paying the internet costs, like a phone basically, and you might be paying their phone bills for a specific reason.
Okay.
But it depends on their role, so it comes back to
if
that.
it's general, the fact that the person is sufficiently senior and tends to log in on weekends and work from home.
Yeah. So you're working from home, yeah, and the question is, like, are you paying all of their internet?
It's on the employer's account, but we then get an annual declaration from each employee, and they'll say they might use it 70% for business or 80%, and
Yeah,
the
okay.
balancing percentage we then pay as
Yeah. That's fine, because it's not 100% that
No.
yeah, that's fine. I mean, you're paying the whole amount, but then you're paying FBT on that 30%, whatever it is that's private. So the declaration spells that out. So that's not a problem. I guess it comes back to, you know, if you wanted to get nitty-gritty about it, I would question, well, what's the employee's role? And that's in their employment agreement. You know, why would they need to work after hours? Is it more joy or is it more requirement? I don't know how they can have joy, but I was looking at FBT on the weekend and that wasn't joy.
I think I will have to start considering mobile workforce. Like a lot of people don't come into the office anymore,
Yeah.
they all work from home. You know?
Yeah, that's right.
There will be, I
Yeah.
see that there's a need to shift their thinking around, you know, those sort of, it's not a benefit. It's actually costing you to have a home office. You know,
Yeah.
that sort of thing.
Yeah, that's right. I mean, if they were in your premises,
Yeah.
the employer would say it's a business expense. And that's why I say you just have a policy around it.
Yeah.
And you don't necessarily need declarations. You have a policy saying you're reimbursing their internet fees, if you are reimbursing it, at you know, $70 or $80 or whatever you think is appropriate for the level of employee. But so it can be a bit tricky, can't it? Because, you know, who's the employee? You've got to think about this. I mean, I had a question on exempt vehicles. And, you know, from an employer's perspective, they would say, yeah, it's a really quick question, Marina, you could answer it in a minute. Well, I can, but I've got to put it through, you know, if this is the scenario, this is the case. If this is the scenario, this is the case. And, you know, do you meet this criteria? And that's where I'm saying it can be a little bit, the nuances are important. So you have to look at all the criteria. So you could be in and out because of that criteria. So non-lodgement is another one, as we've discussed before. Value of car parking, again, there's an exemption for small business entities under 10 million turnover, and a lot of not-for-profits also can get that benefit as well, a separate exemption for that. Employer contributions, if you know, they're assessable, so you have to put them in your FBT return to declare it. And living away from home allowance, I say laugher because you want to laugh out loud. Laugher used to be fantastic in the sense that you had an employee coming from overseas. You know, we do need skills from overseas coming over for 4 years. It was a fantastic exemption. You could pay them accommodation, food and drink. It would not be, for the employer it's deductible, for the employee it's not assessable. There was no FBT, but they took that away maybe about 3 years ago. What they left in its place is something more restrictive and not so beneficial. So you're Sydney based, you want an employee to go to Melbourne, they go down there for a period of less than 12 months, you pay their accommodation, you might pay a food allowance and so on. There's a declaration, probably exempt from FBT, not accessible to the employee, and so on. It's not considered an allowance. So, you know, but you need to take that into consideration. So it's only if you're going interstate, continuous period of 12 months. There's special rules for fly in, fly out, where, you know, they're mining sites or oil rigs and so on. They've got more flexibility. So let's jump to entertainment. So this is an area where I think, you know, you can get it probably wrong, but the question becomes, you know, how wrong did you get it, and is it material? And what I say by material is that some employers really don't provide benefits to the employees, and some employers will say, you know, they might have $5,000, $3,000 bill at the end of the year for, you know, lunches that they're taking out their employees, a Christmas party, yeah, they're tight. But, you know, they go, oh, look, Miranda, let's add it back in our tax return. Let's not pay an FBT on it, or worry about actual method or 50-50 or whether there's an exemption, you know, it's all too much work. Let's just go down and just forget it, let's add it back. Well, you know, look, happy to do that, but at the same time, they have to be aware that doesn't mean that they're off the hook for FBT. So it's up to the employer to take that risk, but you still have an FBT liability which you haven't dealt with. And as you all know, the company tax rate is 27.5 for businesses now in June 2019 for a 50 million turnover, and there's a few other things to consider, aggregated turnover and so on. Whereas investment sort of type of vehicles might be still 30 cents in the dollar. So you can see that rate, 27.5 and 30 versus 47. You want to just not get a tax deduction for it. It's much cheaper than paying, you know, than paying FBT and then claiming a tax deduction for it. So you get a deduction for the FBT expense, but still, it adds to your business. But what we just need to remember is that when you're going down this path, you have to think, am I providing entertainment? So what is entertainment? Entertainment by way of food, drink, or recreation. That's entertainment. Social event, keep thinking of that. Accommodation or travel to providing that entertainment. Seminars, you know, 4-day conference, those kind of things. So the first thing is define what it is that you're providing. What you need to look at is the circumstances for the provision of those benefits. You've got to say what, why, when, and where are you providing it. So if it's non-entertainment, meaning you don't have to go down the FBT route, kick it out before it even goes in there, is if it's a refreshment, you know, cup of tea, morning tea, you know, we provide cookies, morning tea. You should see the selection. You want to come and work here, I'm sure. There's all these biscuits and different teas, exotic, and there's fruit as well because we're very healthy. I think we should take the cookies out, but anyway. When? During working time, bless you. Working time, is it overtime, you know, is it while you're travelling? You know, because whilst you're travelling, it's not entertainment, it's just sustenance. Where? Is it usually at work? Is it, you know, somewhere else? Downstairs in the coffee shop? What's being provided? And so I think it's important that you sort of consider this before the FBT year. going forward into the next FBT year and say, well, what is really entertainment? What do we kick out of entertainment and we put as something else? We might put it to a separate account so we don't even have to think about it because we're using the 50-50 method, maybe we're using the actual method. It doesn't really matter. It's not entertainment, so it doesn't come in. But if it is entertainment, it's a social situation. It's usually a 3-course meal, you know, with lunch. Anybody wants to take me a 3-course meal, I'm there. And if you're paying, it's entertainment, sorry, but I won't. I'm not the employee, so I'm okay. You can not claim a tax deduction on it. Staff social functions, hotel, restaurants, what you really think it should be. But no exemption, and this is if there's an exemption, no exemption if you're using the 50-50 method. Now what I'm talking about above is not whether an exemption applies or not, I'm talking about whether it really is entertainment or not. First thing to consider.
So on that slide, Mariana, the left-hand column where you say it's not entertainment, does that mean it's still deductible?
Yeah, it just doesn't come within entertainment. Yeah, like morning, you know, like you buy coffees and teas for your staff, amenities and so on, that's not, you know, and say you're travelling and the person has to travel from here to Melbourne and has to get a bit of lunch and the employer pays for it. You know, it's work related. Would have been otherwise deductible to the employee.
Is duration an issue? You know how if it's a tax deduction, it's a 7-hour workshop, 3 hours.
Yeah.
Is duration still a factor?
Yeah, the 4 hours, yes, that's
4
right.
hours, okay.
Because that comes under the income tax. Under income tax, there's specific provisions that say that entertainment is not deductible. And entertainment is food, drink, and recreation. And then it also talks about what conferences fit within the criteria of being a conference. So, you know, there's always this, every year there's this Aspen ski trip for chartered accountants. And, you know, I look at it and I go, oh, that's great, looks great. I'm sure there's all skiing and there's no conference. But I think, you know, that the question, would that pass the muster? And, you know, they make it look like it would, and I'm sure it does. But whether you attend or not, that's another issue. Anyway, I haven't been invited. Well, no one's paying for me. So the other thing to consider, so we've just run through this, does the gift constitute entertainment, as we've discussed? If it's not entertainment, then the question is, did it cost less than $300? Now remember, I'm on the actual method here, and it's important to understand which method you're using, but I'm going to use actual for the moment. It's not entertainment. Did it cost less than $300? Yes. There's no FBT. Yes, tax deduction. Yes, GST. If it's greater than $300, then as you would know, it doesn't come into it. You pay FBT. It's still deductible. And then the other, is the gift constitute entertainment? Yes. Then the question becomes, cost less than $300. You have to satisfy other minor benefit exemption, like for example minor and frequent. We'll discuss that. There's no FBT payable. If it's under 300, no tax deduction and no GST. What I want to discuss in the next slide is that for non-for-profits, it's a little different. And I hope that you know this already. A bit fiddly, but not-for-profits. So on the left-hand side is your normal for-profit organisations where you say, I'm using the actual method for meal entertainment. I'm providing a benefit, which is entertainment. It costs less than $300, GST inclusive, provided it infrequent and irregular. And you go to me, what does that look like? Well, some of the things they've said was, you know, like a gym membership, maybe you've done it once that year, once for 3 months. It's minor and infrequent, it's under the $300, and so on. You kind of know what they are. And remember, it's the $300 and you look at it from an isolated employee basis and an isolated transaction. So you look at each transaction separately and you say, am I providing this kind of benefit frequently? And there is no number. There's no magic number to say that minor and frequent is, okay, that's minor and frequent or not. And it can't be for somebody's reward either. So, you know, they made a KPI and then you provide them a benefit. So then there's no FBT, but maybe there's no tax deduction either. Now the other thing is for tax exempt. This is where I just wanted, and raise your hand if you didn't know this, or maybe you did know this and I don't have to worry. So for tax exempt employers, meaning that they not-for-profits, their jars, doesn't matter which one, they don't pay tax. So what the ATO has come out with is that tax exempt bodies don't get the minor and infrequent under 300 benefit. What they get is they get a benefit only if it's provided to staff incidental to outside entertainment. So I have a function on and I invite clients to it as a not-for-profit. Okay, remember, I'm not paying tax. And some of my staff attend it, and I provide some, snacks, morning tea, some like breakfast here today. Well, in that scenario, that could be considered a minor benefit. Very limited circumstances. Or an award night I held on the premises, so I held it at the not-for-profit's premises, and I give them an award and I provide them some food and drink and so on. Well, then again, for the employee and their associates, that's exempt. In most other cases, then they have to consider whether they go down that path of being using the actual method or the 50-50 method. Now, again, when you use the 50-50 method, or 12-week register, which I haven't seen too much of, you don't get the minor and infrequent benefit anyway. So it's only when you use the actual method, and that's for-profits and not-for-profits. But the difference is the under 300 is different for profits and not-for-profits, and they just have to remember that. Because I did go out and I did talk to a not-for-profit, and they were just saying that their benefits are under $300, and I said, okay, good. But you have to pay FBT on it, and I don't think they like me very much. I just want to go through practical examples, and I'll go from point of a profit and not-for-profit, so you both get an idea. So 2 tickets, movie tickets valued $30 are provided to an employee. Is that entertainment? Yeah, it's a ticket to some sort of theatre. Now, if you're a for-profit, you could probably apply the minor, infrequent and irregular. I say if you're providing it every month to that employee, or very frequently, it's probably not, but it's under 300. So you would say, okay, that's minor and frequent, no FBT, no tax deduction and no GST. Okay, so you need to consider all the other things as well. How do you account for that? Well, it's just your accounting records, it's how you keep your accounts and your books. So that's why it's good to decide at the beginning which method you're using and what benefits you're providing. And someone to sort of sit there and contemplate this every time the benefit's being provided. So you have to train the person that's inputting the data, really. You may know it as the person who directs them, but it's really the person who inputs the data, and people forget about them because they're just going to put it anywhere they like. So is the employer tax exempt? If the employer's tax exempt provider doesn't pay tax, then you can't use this minor and infrequent exemption. Any concerns with that? Talk later. Okay. The next one, employee attends a seminar in relation to their work with meals provided. Can the otherwise deductible rule apply? Are meals over lavish, and what association, etc.? So, you can read. Again, why they say these seminars, these are work-related seminars, where somebody goes to a particular spot and is being given a seminar for a certain amount of time. That's not the point. This is a seminar that the employer sent you to. There might be breakfast, lunch and dinner provided, and even maybe dinner afterwards. But if it's all work-related, then the employee would have been able to claim it. So again, there's no FBT on this. So it's just a work-related deduction. Here when we go a bit more lavish, the question becomes, you attend a seminar in relation to your work at a resort. Hamilton Island with a function room, away from the office, 3-course dinner is provided. Now, depends if this is just, a conference, a day conference where, I might go to Tax Institute day conference and they provide me some lunch. That's all deductible. I would have been able to claim that. The question again becomes, if it's under $300, if you're a not-for-profit, would you be able to claim it as minor and infrequent? Well, again, if it's not entertainment, it doesn't matter. If it's just sustenance at a conference, it should be okay. It's more the fact. So this is for more than not-for-profits. Employee attend an external association award event as they're nominated for an award. External, so it's not your organisation providing, somebody else providing. Cost is $100, which includes meal and drink. Can you apply the minor benefit exemption? So they say here that no, because the minor and frequent for a not-for-profit, it has to be on your premises that you're providing the award. Who's going to see $100? Really? So, you know, it's tedious. You've got to come back to reality and say, what are these people thinking? That's where the cost of compliance can be quite large. I always think, let me just go through this here. So yoga classes, talking about, we provide yoga, but I think we provide it frequently. So, but to a particular employee, they may only use it once. They may use it 3 months. But if they're constantly using it, then it may not be a minor benefit. But if you're a not-for-profit, then you don't get the minor and frequent benefit. Christmas party. We all know Christmas parties. Don't touch the Christmas party. So for-profits, Christmas party, we aim to give them a good benefit under $300. And it's the Christmas party event under $300. If you give them a bottle of wine or something, or a gift card or something like a gift, may not be entertainment, might be under $300. You know, they're separate. So you could basically get out of FBT for both of them. So that is for a for-profit, a not-for-profit, and I've got some ATO examples as well. They say you can't use minor and infrequent, so you pay tax on your Christmas parties, either on the actual method or the 50-50 method. Now I wanted to say something more here. Yeah, just consider, is it a social situation that you're providing it, or is it more sustenance when you're providing entertainment? Documentation, keep it for 5 years. It's important that you document so you can prove, what you were trying to do. Volunteers with not-for-profits, they're not employees, so there's no FBT issue. I think that's important to note that. How are we going for time?
9:30.
Okay, great. Okay, we aim to get you, an hour's presentation, even with Melanie talking, and some questions afterwards.
Is the director an employee?
Yes.
Even when the director is of an association,
Yeah.
and they don't get a remuneration, which is
Correct,
bad
yeah.
faith.
They're still considered employee. Exempt vehicles, exempt motor vehicles. And sorry, employee can be defined as current, past, present, so it's quite a wide definition. Exempt vehicles. Now this is a great benefit. Who uses exempt vehicle exemption? Nobody. Really? Oh yeah, okay, now gotcha. Yes, this is a great benefit. And you can imagine what it should be. If you're providing cars or another vehicle. So if you've got a car that is less than 1 tonne, and the car specifications tell you that, less than 1 tonne and carries less than, I think it's fewer than 9 passengers, so less than that, then it's a car. And why I say it's important to distinguish it, because it comes under 2 different exemptions under the FBT Act. Now you'd be oblivious to all this, but there's 2 different areas. One is under car fringe benefit. If you're a car under a tonne, carries less than 9 passengers. If you're over 1 tonne and can carry more than 9 passengers, you're another vehicle, so you come under the residual benefit. It's another exemption. They kind of work the same, but just important to know. So what is a car or what is not a car? So keeping in mind the under 1 tonne and over 1 tonne, but normally a taxi, a panel van, ute, dual car, these are all cars. Now most of these will be eligible cars if they're under a tonne and they carry fewer than 9 passengers. And the question always becomes, when is it fewer than 9 passengers? Well, there's this great formula that you do. You get the number of passengers plus the driver, times it by 68 kilos. So if you've got a lot of fat people, that's great because it's 68 kilos. And I know I weigh more than 68 kilos. So, so it's great. And you get the number, then you times that over the percentage of, they call it here, to have a look at this because, it's gross value mass less curbside weight. So the net, the boys will know, net, and I know just no disrespect to the women either, net carrying capacity of a car. So what's that? The gross vehicle mass, less curbside weight. And actually, the specifications tell you this. So you get the total number of passengers per driver, times it by 68, divided by this mass of the vehicle. And if it's over 50%, then you're a car designed to carry people, and you're not an exempt vehicle. So look at that first, because you could be out. The question became, so why exempt vehicles have been around for a while? The question was asked about, oh look, you know, I've got an exempt vehicle, when is it exempt? Besides all the criteria I just talked about, it has to be limited work travel and private use considered to be minor, infrequent and irregular. What does that mean? What's minor, infrequent, and what does that mean? I drive to work, drive home, I might go to the shop after, pick up some milk, you know, all those kind of things. Well, I might go to rugby after, you know, after work. I've got an exempt vehicle, I'm, you know, under the ton, I'm less carrying passengers, I'm using it for work, all those conditions, the employer tells me it's all fine, but I am using the vehicle for some private use. What's the limits? So how does it practically work? And that's where the ATO has brought this safe harbour. Now, it would have been there as a different form at 31 March 2018. So new guidelines on the safe harbour. So if your cars that you provide to your employees fit within this criteria, the ATO is not going to spend money on you. But you still have to have the documentation. Just remember that. So what's the criteria? Now, obviously the criteria for before 30th of March 2018, slightly different. I'm going to talk about the criteria for post-April 2018. So you have to be providing this vehicle for work duties. We've already established that it's either less than a tonne or more and it carries less than 1 people. It's got to be under the luxury car limit. Now you've got to be careful with this luxury car limit because there's 2 different rates, as one of my staff members pointed out. There's the luxury car limit, which is 65,094, or in 2019 it's 66,331. And then there's the luxury car depreciation limit. 2 different things. And that's 57,581. So take the higher rating. Anyway, so it has to be less than that. Limited private use, so not exceeding 1,000 kilometres in a year, and any one of those return trips is less than $200. 200 kilometres, not $200, I've got money in my mind. And you're not salary packaging the vehicle, and there's a policy that's limited use. That's pretty easy to do, right? Once you think you've put it in place, great, that all fits the criteria. The question is, well, most cars are salary packaged. If you have a salary package and you meet every criteria, maybe a private ruling just to get the ATO's confirmation that you can use a safe harbour. Why is it important to use the safe harbour? Well, it just makes you not have to worry about it. You know, you just implement these things internally and it's done. As long as you know they're meeting the criteria, and the employee just comes back to you once a year, says, look, I used my car private use for this, this and this, well under those limits, and the onus is on the employee to give it to the employer. The employer is always liable, but it's got a policy. Whereas at 31 March 2018, instead of being 1,000, it was 750 kilometres private use, so it was lower. And there was a real big onus on the employer to track it. So, you know, the employer had to really track it, and I'm sure you guys just do that. I can see over there, you probably track it. You know, you're making sure every quarter that you ask the employee what are they using their vehicle for, and you have all these rules. So, you know, it's really onerous up to 31 March. After that date, it's the employee has to report back. It's less onerous of the employer. So I think that's all I wanted to discuss. Anything on those exempt vehicles? No one provides them, so that's okay. Oh, we got off FBT, now we're just doing payroll, we're tracking well. We'll be on single touch payroll for those looking forward to Melanie's presentation. Now payroll tax, something you all have to be aware of. Again, another tax for employers, which is fantastic when you're trying to make profits. But if you've got salary and wages, threshold there, 30th of June 2019 is 850,000. So once you trigger that, so any time during the year you trigger that, you have to register with the New South Wales or other states. So remember that payroll tax is not just, it's state-based. But if you have staff working in Queensland or Melbourne, permanently down there, you know, you have to consider their thresholds and grouping provisions. And the rate is, what did I say, 5.45%. It's paid monthly, and there's an annual reconciliation to be done at the end of the year. Some more reporting, because I'm sure you'll all enjoy that. Administration changes, there's been some little changes. I really don't know if these are fantastic or not, but basically from 1 July 2019, so it hasn't happened yet, if your payroll tax liability is less than 20,000, then you only have to pay it yearly. If it's between 20 and 150, it's an automatic monthly payment at a fixed amount. And then you probably reconcile it at the end of the year. And then if you're above 150, then you lodge it monthly. Now,
Is this limit state-based or is it?
yeah, this is state-based. This is New South Wales. So just keep that in mind. When I'm talking New South Wales, but state-based.
And other states don't have this?
Yeah, other states will have different limits, likely. I didn't look into other states because I really don't care about them. I'm joking, I do care. But no, I didn't. Well, I didn't look into the other states, but New South Wales, but you just have to consider that that's going to be state-based and every state is different on payroll. And payroll limits are different. So there's been some 3 areas that the OSR focuses on. This is New South Wales Office of State Revenue. Grouping requirements is one of the big areas. Employment agency and contractors. They're the 3 areas they focus on. Now, just the 3 cases, well, a few cases that have happened. I'm not going to talk in detail about them, but just to give you a bit of a flavour for what the OSR is up to. So Corrosion Control Engineering is an organisation, and now I've forgotten what they do. I've got my papers here, right? What do they do? It sounds like what they should be. Well, basically this is about degrouping. And basically they've gone in and said to the OSR that you've grouped us together, but we are all 3 separate businesses, and can you please degroup us? I just forgot what they did. Boston Sales and Marketing, I don't know what they do. Anyway, who cares? The point being is, the main thing you've got to consider here, and the tribunal said that you need to consider, is are they commonly owned, like it's the same ownership? Do they have intergroup loans? That's quite important. Do they have the same place of business? Intergroup provisions of administrative services, so are you using the same person to provide the services, and nature of the business. So those are the things to consider if you want to degroup. Obviously they didn't get the degrouping because they found that there was too much control. All 3 were pretty much, didn't meet those criteria. And Cessnock tyres, as you know, yes, they do sell tyres. That was an easier one. Oh, the other ones are engineering. Oh, yeah. Okay, Cessnock tyres, 3 separate businesses owned by 3 separate brothers. They went through a whole heap of trying to say that they're all independent, they had each other, and they run their own business. But then when people look at the facts, what they do is they do buy in bulk at discount for the group. You know, the same sort of directors are controlling the group, even though their name's not there. So it comes down to facts. If you want to degroup, definitely can do it, and it has worked in certain circumstances. And the way we work is we look for cases that work, and then try to build a case on that. Now the other one, this is a great win, I think, for taxpayers. New South Wales, UNSW, the university. So what the, a barrister told me about this once, and I hadn't seen the case until now when I had a look, but it's come out recently. The question was, university was employing experts, so they had a service, and they were employing experts, so they'd go to some lawyers or some accountants and say to them, look, you know, I have a client for the university, they need your expert opinion. So they'd go match them up and they'd charge a small fee. Right? Nothing wrong with that. So what they were saying, OSR, which you need to watch out for, is that they were an employment agency. under these labour hire provisions. The university was an employment agency. And the way you read these provisions are so wide that, I mean, you know, even the AAT admitted that you could catch everything, basically. So wherever you hire an expert to use in somebody else's business or anything along those lines. Anyway, the case was good because what it said was, no, don't be ridiculous. That's not the point of the legislation. Even though it does appear to say that, it's really more if you're employing someone to work in that person's business and they're doing their role as part of that business, okay, that's an employment agency. But where you hire professional services outside to do that service, just provide that service to them, then you're not an employment agency. Why is that important? It's important because New South Wales University was saying they were contractors, so they come under one of those exemptions. But what the OSR was saying, that if we catch you under employment agency, you don't get the contractor exemptions. And I think a lot of employers have actually out there been, stuck with some payroll tax because they've decided to look at these provisions have been there forever, but they've decided to take that a more aggressive approach, if you like, for labour hire. So that's a good case to prove if you get an audit or review from OSR and they're saying you're a labour hire, come and talk to me. May have a case that it's not. And so if it's not, it probably comes under one of the contractor exemptions. Very important. And then we come to the contractors. Sydney flooring, and I see this quite a bit, and look, I think the main thing is no evidence. I mean, we're carrying on a business, we're busy, to write up a report or to do something, get facts on a piece of paper, it takes time. But, it can save you so much money later and trouble. Because you think about it, you go through a review or an audit, you dig out that piece of paper and say, here you go, I've done all my work and here it is. You don't have to spend time, the staff members don't spend time, you don't have to get advisors involved. There are so many things that you can save money from. So maybe a little bit of time up front can save you a bit of money later. So with this Sydney flooring, basically, as you know, they're tilers, they're a tiling organisation and they get the tilers in. Now the tilers have got really no way of being involved in the pricing. The organisation does the pricing. They call the tilers up and say, are you available that day? Yeah, I'm available, great, come and put these tiles in. Okay, fantastic, I'll do that. But effectively, they was trying to say that these guys are contractors. But unfortunately, they probably didn't come under any of the exemptions. And one way to really test it, because I've had this for a client, and we won the case, which is great, is that look at the income for the contractor, and the ATO has all that information because they've got the tax returns. They look at the income and say, where did you get all your income from? It was from one person. Likely you're not a contractor. So, that's an easy test to do. Ask the contractor, are you just working for me? And, tell them about the fact the ATO can find this out and they'll dig it up. But the main thing is keep evidence that they are a contractor. If they had done it differently and put an agreement in place that the contractors have to decide on the pricing, maybe not good for business, but if they put that contract in place, well then maybe they could argue that they were contractors. So now we've all been waiting for it, single touch payroll, and we're nearly towards the end.
Okay, so single touch payroll. So, as many of you may know, from 1 July 2018, single touch payroll was introduced for employers with 20 or more employees. Basically, the idea behind it was the ATO wanted to receive real-time salary data, so they can do some data matching with what employers were providing on their activity statements with paid scope withholding and with obviously superannuation. So, the requirements of this means that employers must use a single touch payroll compliance software and, like I said, provide data in real time. So basically, whenever an employer processes a pay run, as soon as that pay run is finalised, the data is automatically transmitted to the ATO, and this obviously is going to include your salary and wage details, your paid scope withholding, and your superannuation. Along with that, it's also going to include some of the employees' personal information, so their tax file numbers, their date of birth, their address, and that sort of thing. Now, because of this and because of the real-time data, there's actually no longer a need for employers to provide pay scope payment summaries. Because of this, now all that an employee needs to do is basically, once the financial year is finished, click a button to say, yes, the full year has been prepared through this software, all the data is correct, and that will automatically get transmitted to an employee's MyGov account. So that's one thing that is quite important now, is that employees can see their year-to-date payroll data through their MyGov account. So that's one thing I've been really recommending to employers, is to just make employees aware of this, that they can access that, because they can access, in essence, their payment summary through their MyGov. So that's what's currently in place. Now, from 1 July 2019, this has been implemented, or will be implemented for all employers. So this doesn't matter whether you have one employee or as many as you like, everyone has to comply with these rules. Basically what it's going to mean is, if you already have a payroll software that you're utilising and you have less than 20 employees, all you need to do is basically turn it on, because most payroll softwares are compliant. What I would recommend is you check with your accounting software provider, to basically just ask them, look, is this version of the software I'm using compliant? Because I know we have had some queries from clients where they're using outdated software, which isn't. Sometimes we don't know that. So if you speak to the software provider, they'll be able to tell you exactly what is ready to use. And as at 1 July, all you need to do is turn it on. And basically all that means is, like I said, when you finish a pay run, it's a separate button you've got to press to transmit the data to the ATO. Now, if you don't have a current payroll software, what we would be recommending is, depending if you're using an accounting package, maybe utilise the payroll software within that accounting package. Alternatively, get a separate software provider. In saying all this, the ATO have said and released a few concessions. So if you have 1 to 4 employees, the ATO are deeming you to be a micro-employer. And basically what they've said with that is that they will provide they've asked some software providers to provide a no-cost or a low-cost software solution. So that's basically going to mean you will only have to pay less than $10 a month, and you'll have some form of payroll software. So the idea behind that is it's a much simpler version of rather than a big payroll software that can be quite clunky, they need a lot of information. It'll be a simpler solution where they'll need kind of minimal data. You'll need obviously all the employee information still, and the salary documentation, but it'll be a little bit simpler and easier to use. The next concession that they have released is in relation to closely held employees. So what this means is, if you're a business and you're a mum and dad business, you just employ each other, so you're a director, you're a family member, your particular salary as a closely held employee doesn't need to get reported through single touch payroll for the first year. So what that means is, for the period 1 July 2019 to 30 June 2020, any closely held employees don't need to go through single touch payroll. In saying that, if you have even just one arm's length employee, you still need to report their data. So that could mean you'll have, like I said, the 2 directors that are receiving a salary, they don't need to be reported, but you'll have 2 or 3 arm's length employees, they still need to be reported through the software. So I just want to make that clarification. What they've also said with this is that from 1 July 2020 you will need to report, but there will be some concessions, and they haven't, the ATO haven't quite clarified what that's going to be yet, but they have said that likely you'll be able to report this through your tax agent. So we might be able to report the data on your behalf, and it'll be some kind of separate report that will be lodged on a quarterly basis. But there's still not a huge amount of information in relation to this yet. And the final concession is that they have actually said they've given a bit of leeway. So for employees with less than 20, you have up until 30 September. So if it takes a little bit longer to merge onto a payroll software, that's okay. But as long as you're up and reporting by 30 September, the ATO won't issue any penalties. And similar to what happened when they released it last year, they've given the same deferrals and exemptions. So if you've got issues where you are remote, employees in remote locations that don't have any internet access, they might be eligible for any deferrals.
What I guess I want you to take away from today is that FBT is fiddly. And if you want to have a bit of a chat with me or with any of your advisors, tax advisors, because there's 5 tax advisors here, myself, Peter Benbury, Tony Fittler, Neil Wickton, Joel Dare. Did I count everyone? Yeah, and so. But I always recommend probably, obviously we won't do this in the meeting, but discuss whether it's good to do a FBT health check, payroll health check, or GST health check. And we can do those things if you need it. I want to thank everyone.